I personally believe that companies and prices at the end of the day have to be underpinned by earnings, right? And if you simply break it down, there are only two components of stock price. One is earnings, and second is the multiple you put on it. Right. The multiple you put on it.
The multiple is basically the stock price to the earnings.
Yes. So P multiple in the common part.
And earnings is just to simplify it. Earnings means, let's say, PAT.
Yes, PAT or earning per share. So if you are looking at stock price, you have earning per share into P, that gives you your stock price. Right. Now, in my view, the multiple itself is determined by the earnings.
Okay.
Right. Because and not just earnings in a static sense of view, but earnings over a period of time.
Right.
And for more financially inclined listeners, it's more your discounted cash flows. Right. So how you are discounting those earnings, so future earnings, and then the other external variable is the interest rate or the discount rate. Right. So I believe that as long as earnings are going to come through, one is in a good, happy place.
Right? And just on the previous comment, the PE is higher if the earnings is consistent and growing.
Yes.
Because then you are kind of discounting a larger cash flow, and hence you are like the price earning is also kind of another way to think about it, is that the earning is what you get this year, and the price is what you're paying it for holding it for many years. And so in many ways, the price is the number of years you are willing to wait for the earning to come through.
Yes. And earning growth to come through.
Exactly.
Right? So the key thing one has to watch out for is what is the earning growth expectation over the years, and how confident you are. Right. Because if you are more confident about it, you will project it for more number of years. Right. To kind of take a simple example, look at a commodity company versus a consumer company. Right. There are many reasons why they trade at varying multiples, but typically you will find commodity companies trade at a lower multiple versus a consumer company which trades at a higher multiple. Right.
And the deltas can be quite, like, commodities are at 4-6, whereas consumer can be 80, 100.
60. Right. And the reason for that is in commodity companies, you're not sure of the earnings. Right. There can be huge volatility. If the commodity prices are not favorable, the company can even incur losses for the period of time. In consumer companies, you are more confident of a consistent period of demand, and typically in some ways you can think of it as like a bond. Right? So bond has a steady cash flow. This company has a steady stream of earnings, and if it's a good company which is trading at high multiple, then the market is expecting that this earnings will actually also grow over the period of time, and that's why the discounted value of those earnings is much larger than when you discount a volatile period. Now, for market levels, we kind of can simplify it further, right? So one way to do it is look at market earnings and market multiple, right? A PE multiple. But another way to do it, which I find useful and which is a very broad thumb rule, is look at market cap to GDP, right? Because GDP is total national income, and market cap is your aggregate all listed companies. Of course, these are not accurate measures. There are companies that are unlisted, etc. But I think for a very broad sense of analysis, I find it useful. And to look at market level, one can simply look at market cap to GDP, right? So what one market is trading vis-a-vis other market. To give you some context, India is today trading at about a little over 100% of GDP in terms of market capitalization. The historic average actually for India has been 75 to 80%.
So it's already at a premium.
It's a premium for market cap to GDP, right? Now, to complicate matters more for you, we have taken GDP as an approximation for earnings potential, right? But company profits to GDP is also variable.
Variable, yes. Right?
And we have seen, I think the last peak was 2008, when we had seen corporate profits to GDP go up to about 6%. In 2003 or 2002, they were like 1.7% of GDP, right? And you would remember we had a very great returns from the market from 2003 to 2008, and that was backed by corporate profitability, right? So corporate profitability grew from 1.7 to 6% of GDP. Of course, again, over the past decade, it's not been great. So I think the recent bottom was about 2.2% of GDP as corporate profits. Last couple of years have been great in terms of corporate profitability, and now we have again actually moved up to about 4% of GDP in terms of corporate profits.
Right.
And again, the expectations are that this upward journey will continue, and we'll probably move up to 6-7% of GDP, right? So I think this kind of gives us a bit of confidence that yes, you can live with a higher market cap to GDP because your corporate profitability to GDP ratio is also moving up.
Right. And perhaps that's why there is a premium.
Yes, right. And then for return expectations, therefore, you see, okay, what is your nominal GDP growth expected? On top of that, you overlay how you expect your corporate profitability to GDP to move. And so if we have a double-digit nominal GDP growth expectation and you overlay a improvement in corporate profitability, and market gets comfortable that you get 19-20% earnings growth coming through for the next couple of years, and that's helped markets trade. So today market is somewhere around 19 times forward earnings.
Right. And so on the market cap to GDP, we are at a premium over historical numbers. How about on these price multiples? Like, how does that look compared to
so price multiples is also a premium. So the historic average is about 16 times. But as I said, we don't need to necessarily worry about that because profitability is expected to improve, right? And of course, the risk is if this improvement does not come through, right? And I think both as a profit to GDP as well as nominal GDP growth, right? Because if you see the first quarter print, the nominal GDP growth had dropped to 8%.
Right.
And while all of us really focus on real GDP growth in all media and all discussions, but really for corporate profitability, corporate top line, it is nominal GDP growth that matters, right?
So inflation actually is positive in some ways.
In some ways, to a certain degree. To an extent, inflation goes to a level where real rates become negative. Then there's a challenge, and what we spoke about earlier, the discount rate starts changing, and it has an impact on PE multiple, right? But I think at the end of the day, when we are looking at corporate profitability, it is nominal GDP growth that is important for us.